The Vancouver real estate market has largely held strong for 2024, with home prices rising in the first 5 months of the year. But things look like they are about to take a turn. We have 2 years of high rates, 10-year low in sales volumes, and an eye-watering spike in business and consumer insolvencies that are all pointing to the likelihood that real estate prices are about to start coming down. The June Vancouver real estate numbers are out, and we're going to dive into them and talk about how low these sales actually are, how low prices may go, plus give you some updates on these terrifying insolvency numbers and an update on the small-scale multi-unit housing initiative. And lastly, talk about this new tenant laws that have just come out, whereby landlords now must give 4 months notice when a property sells and the new owner is looking to move in. Hi, everyone, and welcome back. I am Dan here with my partner, Ryan. We are here every single week bringing you what is important in Vancouver real estate. Let's dive into what happened in the June numbers here. We always start off with the health of the market, aka how many homes sold. And June was slow. We're still, quote, sick as a dog when it comes to that health standard. Just under 2,400 homes sold in the month of June. And that's down from last year, 19%. Pretty significant considering last year was definitely on a slower trend as well. Month over month, a big 13% drop. Yes, things start to slow down in June, but that's even an accelerated rate of decline there. We just saw the second consecutive month of sales lowering month over month. And let's look at the big picture here, right? How does last month look like when we compare it to the 10-year average? 24% lower sales. Slow. It's the slowest June, of course, dating back to 2019 as well. And it is the third sort of year in a row where we're seeing the entire year slow down in sales. We had that blow off top back in 2022, and things have just slowed ever since. And we're really starting to feel it. If you're out and you're in the industry, you feel how slow it is. Your colleagues say how things are pretty darn slow. The mortgage specialists are feeling it too. And ultimately, with sort of the rate of these new listings that are coming out, the rising inventory, the high interest rates, and predominantly owners just still choosing to stay locked in their homes and buyers remaining on the sideline, well, the rate cut that many thought would bring buyers has actually brought sellers, as we see in the new listings and the new inventory numbers.
Yeah, let's get into the new listings here because it's quite interesting. June was the third month in a row with elevated listings. In fact, it's the highest amount of listings in this month in the last 3 years. So we've got 5,737 new listings. That's a 7% increase year over year and an 11% decrease month over month. Now, that sounds like good news if you're a seller, but this is very typical and very seasonal. June is typically slower than May. So we're 3% right now above the 10-year seasonal average. And we have certainly felt that sellers are looking to get deals done. And this is evident with the amount of new listings that keep coming to market. Speaking to our own year, much kind of like Dan has alluded to here, it's been a lot more of listings than we would typically see. Folks are largely looking to sell and buy, or they're looking to, get rid of their Airbnb property. Their investment property no longer makes sense. And that's due in part to the high rates and rent not being able to service the debt. So, we've seen a significant change where we're either looking at both sides of the transaction or people looking to stop the bleed.
So how did all these new listings affect inventory? Well, first, a quick caveat here, because when the GVRD releases their email every month about the stats, there's one metric that's oddly different than the graph, and that's the inventory number. For example, just this month, the email stated there was about 14,200 active listings, whereas the graph shows 13,400. Ultimately, the email can be off, it can be a typo, but the graph is actually updated as the data kind of settles. So I always reference the graph in these updates, and we're going to do that again now. But if you ever hear a number that's slightly different from another news source, it's typically because they're reading off the email and not the graph adjusted in real time. Anyway, let's get into it. So as mentioned, right now, at the end of June, there was 13,400 active listings. That was only a 0.5% increase month over month, which sounds shockingly low. But again, pull back. What's the bigger picture? 35% increase compared to this time last year. Obviously, a lot more homes to choose from right now. And let's pull back further to that 10-year average. We're sitting around 20% more listings than the 10-year average. Currently at a 4-year high and the 6th monthly increase of inventory in a row. But here's a bit of an outlier piece of information. Detached and townhome inventory both increased month over month, but somehow condo inventory actually went down in the month of June compared to May. And of course, that's hard to believe, especially when we look to our partners in Toronto, for example, who are experiencing a blow off top high level of condos actively listed in their city. We'll see how it pans out over the future months here, of course. But what happens at the end of every month, though, is a lot of listings will expire, or maybe they'll pull them off the market, only to be relisted on the first active day of the next month. And that happens every month. It's very typical. So we take that number, that 13,400, and then they pile on the active new listings. I mean, on July 2nd this year, there was over 800 new listings in one day. So where does that put us today? Today, you go shopping and you've got 14,700 homes to choose from. That puts us back at sort of a 5-year high. But here is where things start to get really, interesting. If we see another 1,000 homes listed and they stay active for a while, we'll be at a 10-year high in active inventory in Vancouver. And I fully expect that to happen during the month of July. So let's take this information all together now. We've got 24% lower sales volumes than the 10-year average. Combine that with inventory that's 20% above that 10-year average. Well, ultimately, those two metrics alone, based on supply and demand, means that pricing has to come down, right? Well, I think it will, absolutely. And all the data, especially these next figures that we're going to discuss, really point to that likelihood.
Yeah, there's a lot of metrics that kind of support that argument right now. And sales to active ratio, the behavior or the temperature of the marketplace, is another example showing that we're headed in this direction. And I wonder, Dan, if we're seeing this sort of adjustment, this shift, if you will, in condos versus townhomes and single family inventory is largely around affordability. I mean, based on the stats released here, we know that single family homes are averaging a whopping $2,061,000 just on average for a single family home. And so for me, it's pretty evident as to why this particular segment is stalling. The townhouses is kind of surprising to me that those are stalling. And really, I think affordability is the measure why people are moving into condos. And also, they've likely got the most amount of inventory to choose from there. So it's very interesting to see. Now, as we look at the temperature here, so the overall sales to active ratio here for the month was 18%. And that's down 3% month over month, which means we went from a seller's market into a balanced marketplace. What's more is this is the second monthly drop in a row. 3 months make a trend. So for the first time, we are in a balanced market since January of this year. And if we separate it by asset class, we've seen a fairly significant shift, down 3%, sitting at 13% now for detached homes. We're bordering right now on a buyer's market here for detached inventory. Townhomes dropped a whopping 5%, now down to 23% overall. 21% is where we're seeing, for apartments, and that's down just 1%. So I also suspect we're going to see this downward trend over the summer. It's hard to know if we'll experience another leg down like we've seen in the past when it comes to prices, but I do believe as we continue to slow, we will continue to see a price correction. It's almost inevitable at this point.
So let's talk price. What has happened and why do we think it's going to start trending down? Well, we saw HPI increase every single month of 2024 up until June. Last month, it actually dropped for the first time in 2024 here. It went down about $5,000. So the HPI, your typical home price right now, $1,207,000. And we're almost flat now year over year. We're only up 0.5% from where we were this time last year. We also like to break down the other two price metrics being median and average. And let's talk about what those did. Median dropped $18,000 last month and is now sitting at $980K. Always fun to reference that all-time high for median, which happened back in 2022. We're 2% below that. Average, on the other hand, actually increased last month, up $2,000. Average homes are now sitting at $1,350,000. That's a new all-time high, and that beats the previous all-time high of just last month, May. So we have two consecutive new all-time high prices in average. And for reference, that previous sort of all-time high we saw back in 2022, we're only 5K higher than that. But again, that's when rates were 0.25%. Today, we're at 4.75%, and all average prices are hitting new all-time highs. So how can we hit all-time highs and we think that things are going down? Well, we are always talking about the HPI price here when it comes to, I guess, sort of the grand scale of prices, or the price that the media will always discuss here. Anyway, I believe that we've kind of peaked in HPI for this cycle. The high rates are really taking effect now. Inventory is spiking like we haven't seen in almost 10 years. And we continue to see a very low sales volumes rate. I think Vancouver is ultimately held on as long as it can when it comes to pricing here. And while we just saw household net worth hit an all-time high last month, the opposing forces that would push prices down, I think, will become the dominant force in the foreseeable future. How much a price of houses may drop is kind of anybody's guess, of course. But today, my guess is to expect these prices to lower for at least the next 4 months. And realistically, there's just too many variables beyond that type of time frame to know what'll happen then. But obviously, we'll keep you updated month on month here as things change, as rates possibly change, and as prices change.
Yeah, and speaking to days on market here, another very interesting metric that you'll want to pay attention to. We're sitting at 14 now, so roughly 2 weeks to sell your house. That's up 2 days from the last month, though this is now the highest it's been since February of this year. Again, I suspect to see this rise throughout the balance of the summer as it kind of directly correlates with pricing. And if you're a buyer or a seller, this is an important metric and something you can check quickly when you're looking at listings or if you're looking at your own listing. This is how I would interpret this. So if you're priced to market, meaning you're accurately priced, your home should take 2 weeks to sell. So if you're sitting on the market as a seller for more than 2 weeks, chances are you're not selling anytime soon. And that's because buyers are extremely fickle and we're moving into a buyer's market here. It's evident. We can see this coming. So if you've mispriced your home and you don't get in front of it now, your days on market are going to continue to climb. And if you don't jump down to where the market is, you don't lower enough, you're going to catch a falling knife and you'll have to continuously drop your price until you get in front of it. So if you can do that now, you can get in front of it, you'll likely sell. If you don't, you could chase it all the way down until we hit a bottom and start coming back the other way. This is a great way, this days on market is a great way to interpret how well your listing is going. And if you're a buyer and you see 30, 50, 70, 100 days on market, that's your opportunity, right? So with that being said, though, we're seeing new policy changes overall that are kind of creating more inventory and creating an environment where things are taking longer to sell.
Something else that may obviously increase inventory here is looking at the insolvency rates when it comes to businesses and consumers here. How much money is sloshing around? How in debt are people getting and having to make some pretty hard choices moving forward here? While the arrears rate within mortgages still remains below pre-pandemic levels, that does not mean they're not extreme cases of financial stresses within our system right now. We've talked at length of how people will always pay that mortgage first. People will keep a roof over their head. They're going to pull back on the luxury spending or the discretionary spending, and then they're going to tap into lines of credit or credit cards when things get even worse. And then all of a sudden, those payments aren't even viable for people. And we're seeing that now in the numbers, right? Many businesses, especially those with high interest debts, are suffering. And people are getting behind on these credit card and line of credit payments. There is a graph that we're going to share here for everyone watching on YouTube, and for anyone listening, I'll walk you through it. But essentially, this graph shows the dollar figure, the liabilities in insolvency filings, and it's year over year, and it combines consumer and business insolvencies when looking at the most populous provinces in Canada, being, of course, BC, Alberta, Ontario, and Quebec. The chart goes back to 2015, and up until about the middle of 2022, the month over month and year over year insolvencies basically bounce up or below almost zero. But then something drastic changes in the middle of 2022, and it starts to shoot up dramatically and is absolutely spiked and is sitting at an all-time high today. So this rate of liabilities in insolvency filings, which typically bounces around 0%, has shot up to a 1,750% increase. A massive amount of money, amount of debt here cannot be absorbed, cannot be paid here by the consumers and the businesses that have this debt. And what's going to be the result of that? Well, understandably, businesses will go out of business, resulting in a ton of layoffs, which means people can't pay off their credit cards, their lines of credit, and then ultimately their mortgage. So it's gone on for 2 years here now, and we just seem to be kind of pushing or kicking that proverbial can further and further down the road, but it's feeling like things are breaking now. And for those people who, quote unquote, have to sell, I think we're going to see more of those. And it doesn't mean that they're going to lose money, because probably they've held that home for 3-4 years and it's gone up in price, but it's not something they want to do. Either way, I think this is also going to start to contribute to the overall inventory, and we're going to start noticing that within the coming months for sure. I also expect a spike in inventory come September, when there's typically higher sales volumes.
Yeah, and I largely tend to agree with that. With that being said, though, let's also take a look now at the new tenancy laws in BC, because I think they're surprising and honestly going to have a largely detrimental effect on the overall rental market and certainly on the overall sales market here. So effective July 18th, landlords now must give 4 months notice to tenants if they intend to use the home personally or if they're going to sell the property. So if you're a buyer today and you find the perfect home and it's tenanted, if you make an offer and you remove subjects and you get excited to move in, you're going to have to wait a minimum of 4 months notice, right? So that's whatever month you're in plus 4 months. So today, for example, or when this comes out, it'll be July 6th. So you'll have to do the balance of July plus August, September, October, and November, meaning you don't get to move in now until December 1st. Unless, of course, that tenant happens to find another property in that time frame. But don't expect that to take place. But wait, there's a kicker here, because your mortgage pre-approval for the home you just bought is typically 90 to 120 days. So if you're in the middle of that pre-approval schedule, you could no longer be approved for the mortgage that you've been approved for in time to buy the house. Some banks may be able to extend, but other banks may require you to do a pre-approval in that process. But hold on a second here, because a lot can happen in 4.5 months. And what if you've got a job change and you're no longer getting paid what you were getting paid, or you go on mat leave, or you're temporarily laid off? There's a lot of potential scenarios here that could alter that course. So what does this mean? Well, I expect tenanted properties, to sit on the market for a lot longer now. There will be even less demand for investment into the real estate market from people looking to provide the much needed housing for the tenants that require them. And while this may seem like welcome news to tenants who get more time now, more notice to move, it's really a nightmare for anyone trying to buy or sell the property, and will likely do more harm than good, as less people will buy and sell those particular homes. This will ultimately continue to push rental prices north, as more and more investors will pull out of this space, will stop providing the housing. They're not going to rent their basement suites anymore, and that'll become more restrictive. As a result, you're going to also find investors deploying their capital in other markets where they just simply don't have to deal with this kind of problem. So overall, I think there's probably more detrimental effects to the overall marketplace then there are positive ones here. And it's kind of, in my mind, not very well thought out.
It definitely seems to be yet another policy that was not advised on properly by industry professionals and was really focusing on only one side of the equation. Because ultimately, I truly believe it will push up rental rates when there are, of course, fewer and fewer properties because they're less desirable for the investors to bring them to market. Why would you? I get that. And that hurts rental affordability. And let's stay on affordability right now. Affordability in our province, in our country, has been top of mind for years now, and it continues to evolve. There's just been so much talk about it. And I think a lot of people are starting to also recognize that there's a big focus on the city and sort of how much they are to quote unquote blame for the housing affordability and how much they increasingly affect that when it comes to their fees. That, let's be real, all these fees, they do get pushed on to home buyers. Now, the new small-scale multi-unit housing initiative has apparently opened the floodgates, opened the doors for these cities to grab even more cash. Because I just want to take a minute here and discuss sort of all the finger pointing that happens when it comes to affordability. Historically, developers have kind of been the easy target, right? They're the ones to blame. They're the ones who are greedy, and they're making all the money when it comes to bringing houses to market here. But sort of as just mentioned here, a lot of people now also recognize the fact that cities, especially the bigger ones, Vancouver and Toronto, they're taking upwards of 30 to 33% of the cost of a new home in fees and in taxes. You buy $1 million home, $333,000 of that is in city fees and taxes. It's just an immense number. There's other people involved in housing and bringing houses to market. And here's an interesting sort of scenario to play out. When's the last time that you pointed the finger at a homeowner to blame for housing affordability? Well, here's an example. Right now, we're working on a land assembly. And this land assembly, it's about 6 or 7 lots in a row here. And should one of those lots just go to the open market today, they'd probably get $3 million. Great number, okay? You could definitely retire on that kind of money. Let's say you've owned that home for 20 years and you're free and clear. These properties were actually assembled a little while back, a couple of years ago, and they generated an offer. They were offered $4.8 million for these lots, each one. The homeowners said, no, we don't want that. We think our land's worth more. They want $5.5 million. And they believe they can get it. And with the new rezoning that's recently happened and the new TOA zones, well, guess what? They just might. It's very possible. And that's a massive difference. I mean, we're talking about a $700,000 lift. Realistically, all these homeowners anywhere that are in a similar scenario, they've got one chance to sell. And if they've lived there for 20 years, they've owned the home outright, and they say, look, this is it. This is our retirement. When we sell this, this is what we're living on. This is what we're gifting the children, whatever the case would be. So knowing that you could get 5.5 million or 3 million or somewhere in between, what would you do? Would you openly go, okay, yeah, I'm fine. I want to help Vancouver's affordability. I'm selling my house for 3. I don't care that my neighbor's selling for 5.5. Or do you look at that $2.5 million difference and say, that's a life-changing amount of money, and I'm actually going to hold out and get that because I want to do right by my family? Can you really blame them? I mean, look, I'm not here to say that's right or wrong, but put yourself in those shoes and honestly ask yourself, what would you do? And then ultimately, you've already lifted the price of that next home for the next person to buy it, right? It starts with all of us. Let's be honest here. Ultimately, every person who touches a new development tries to get or charge as much as they can for themselves, right? Starting with that landowner. Then let's talk about what? The builders, the developer, the architect, interior designers, the arborist, the landscaper, the engineers, the city, painters, stagers, electricians, plumbers, the listing realtor, the buyer's realtor, the inspector, the lawyers. How many of those people along that chain are offering their services for free or even a discount to help affordability? Hard to say many. Let's be honest here. There's, over a dozen industries that are involved in the development of property, right? And we're talking about, let's say, a condo building here and hundreds of people. And every one of those people, everyone has a life that they're trying to live and a service that they trade for money. This is not a unique scenario. And what we continue to see here, of course, is that people will ultimately charge what the market will bear. Now, I want to expand a bit here on those fees that we just touched on, because, if we're already at 30% of a new home price, is that enough or should they add more? Well, the city is, again, looking at the small scale multi-unit housing initiative as one of the easiest cash grabs out there. We've discussed how Vancouver is charging a density fee if you would like to bring homes to market and help the inventory crisis. That initiative is about $140 per foot. So if you're looking to densify on your lot in Vancouver on the west side, and you want to use a higher floor space ratio, it's $140 per foot they're going to charge you for that. And well, this week, we learned of even more fees that are being created along with the rate of increase that the city has decided to charge during the next 3 years. So I'm going to quickly go over these fees and just recognize every fee that I'm talking about is per townhome created. Okay. So there's a new one called the Parkland Acquisition DCC, Development Cost Charge, $0 today. But when we get to 2025, they're going to start charging $442 per unit. 2026, it goes up to $884. And then in 2027, $1,751 per unit. Okay. Listen to this one though. The regional water fee, it exists, about $5,700 today. That increases to $9,800 next year, $15,000 in 2026, and $17,710 by 2027. That is a 300% increase in that charge in just the next 3 years. But wait, it gets worse. The liquid waste development cost charge is about $3,000 per unit today. By 2027, that increases to $11,400. That's an almost 400% increase in that one charge alone in just 3 years. So when you hear that the city of Vancouver here is increasing such fees by 300 to 400% over the next 3 years, over 100% per year, it gets a bit difficult to believe them when the other side is trying to tell you that they're trying to make housing more affordable. It just doesn't equate.
Yeah, if anything, I think, Dan, what we're seeing here is that the city is becoming one of the biggest contributors to affordability, or unaffordability for that matter. And I don't know if that's a result of improperly dealing with this over the last decade or the last 2 decades or 3 decades in terms of not understanding what their future costs are going to be for infrastructure. But largely speaking, these fees are astronomical. And it kind of shows you where the prices of new property could be heading. With that too, I also believe, much like you talked on with respect to the individual landowner, when you are talking, I think, maybe morally or ethically, everybody wants affordable housing right up until it's their own home. And we've said that many times before on the podcast, and I think we'll continue to see that as a result here. You bring up a really good point is sort of, ultimately, how much do we care about our future generations and what are we doing to help them get involved, especially in home ownership? And when you look at this, it's as if we don't care, because you can drive up all the fees you want. You can make things more expensive to build, or they have to become more expensive to build. But what are we doing on the flip side to help people get in? What are the initiatives that we're doing to get people into housing? One does not correlate with the other. In fact, I think it's pushing them further and further apart.
Totally agree. And let's talk now about the Multiplex Plan, right? The small scale multi-unit housing initiative. It is past June 30th. So all cities are meant to have adopted this initiative now and basically put forward their bylaws as to what could be built. And we do have some data as this has been in the works for a while. And we're going to really get into updating you on this over the next couple of weeks here. What's the adoption rate looking like here? Well, as of April 19th, so this is a bit of time ago, but it is important to share. So as of April 19th, when we look in just the city of Vancouver, there's been 113 development applications submitted. The majority of those are for triplex and fourplex units. Only 19% so far are for sixplex. And keep in mind too, the city also offered additional density if developers went straight rentals, right? You can now build up to 8 units on those lots if you're building purpose-built rentals only. How many applications for those? 0. And why is that? Why would they not do that? Well, a quick breakdown here. The cost to build an 8-unit rental building in Vancouver is around $6 million. Okay, you take $2 million to buy a decent lot and $4 million in your combined hard costs, soft costs, city fees, financing. Sure, you could spend a bit less, and sure, you could spend a lot more. If that resulted in, let's say, an 8,000 square foot rental space and you're getting $4 a foot, well, that's $32,000 a month in rental income. Okay. If your project was to be fully paid off, it would take 16 years in collecting rent. On average, we're pretending that it's not going to go up. You get the idea here. Even before you would really start to see a profit. And that's not even taking into account all the maintenance and upkeep costs, right? Which of course there are. So ultimately this might take you 20 years to break even. So, no kidding, there's not really that much incentive for developers to build rental units, right? When they could take 24 months, build, sell, make some profit, move on to the next one, still bringing almost identical product to market essentially. Now, that's just saying that the multiplex plan isn't really built for rentals. No, don't worry. There's a lot of rental towers being built right now. And yes, they're mostly condos, but again, they are being built as best they can. Of course, maybe not as many investors to buy these and bring them to market though. So understandably, there's just the allure to help bring rental product to market, and now piggybacking these new tenant laws. It's just, it really makes me worry for that segment of the marketplace.
Well, and also, do we need more rental condos, or do we need more different kinds of asset classes for people to rent? So it's like, this policy change, again, wasn't thought through far enough. We don't need another 2,000 rental condos. We need different kinds of housing for people who have families and different kinds of needs. Not everyone can fit into a condo. So that, the fact that we're building all of these condos for rental is fine and will help maybe temporarily, but the same problems are going to persist and end up, just further down the road for the very same people. And much like our discussion here with the ex-CFO of Mosaic, this policy just really hasn't gone far enough to address the density issues that we need or the affordability issues. Furthermore, different municipalities are responding to the regulatory changes in different ways. So what you're going to see in Burnaby is not what you're going to see in Vancouver, and it's not what you're going to see in North Vancouver. So it makes it even more difficult to understand where these opportunities are going to happen. And I'm just not sure we have enough bureaucratic change to incentivize private industry. It's one thing to put forward, a policy change and say, hey, listen, you can do this, but if there's not enough incentive, it's never going to happen. And you have to understand where the builders are. You have to understand where the margins are for these people in order to create the right incentive. And it just doesn't seem like that level of work has been done. It's just simply not good enough. And simply put, there's going to be better markets for home builders and developers to deploy their efforts in if we don't change this or continue to modify it.
So lots of changes, as there always are. The times they are a change, and maybe you're curious as to what's going on. Well, hey, Ryan and I, we're very approachable and we love to talk real estate. You can book a consultation, a talk with us anytime. Use the Calendly link below and we'll explore your scenario. Are you looking to buy, sell, rent, leave the country? We're here to talk about it. Totally understand. And hey, thanks as always for tuning in, watching, and listening. We will be here next week with another very exciting and interesting episode on what is happening in Vancouver real estate. Thanks. Bye.